Shares of US bank First Republic have plunged more than 50%, despite an earlier move by other banks to inject $30 billion to keep it afloat. S&P Global Ratings has also downgraded the bank for a second time in a week, causing investors to worry whether First Republic can survive. It follows the collapse of Silicon Valley Bank and New York-based Signature Bank. On the weekend, fears over an ailing European bank, Credit Suisse, were allayed after the Swiss government pushed for a takeover by its competitor UBS. We'll get to Credit Suisse in a moment, but first, James Sweeney is in New York. James, how did First Republic get into this mess?
Well, I could say that they were being foolish, but that's a little too broad of an answer. Truth is, similar to the now defunct Silicon Valley Bank, which you mentioned, First Republic Bank's deposits mostly uninsured, about 2/3 of them. Making matters even worse, according to S&P Global, First Republic also had a 111% loan-to-deposit ratio at the end of last year. That means it loaned out more money than it has in deposits. And that's not smart. I can pretty much do math that makes no sense. Not something the 14th largest bank in the U.S. should be doing, but they did. And once Silicon Valley Bank went under, the red flags were everywhere for this bank as well. And even more interesting, several of First Republic's top-ranking executives selling $12 million in the stock in the 2 months leading up to this crisis. This is publicly disclosed information, and that, quite frankly, is how First Republic got into this mess, down about 88% this month so far.
Yeah, so less than stellar finances and broader worries influencing that. But what happens next with First Republic?
That's the big question, and there's really no answer yet. It's like every morning we wake up here on Wall Street, there's a new update on the banking sector that dictates the market direction. Like today, First Republic down about 40% heading into the close. This after receiving $30 billion in deposits from 11 of the nation's largest banks last week to ease liquidity concerns. A move that was meant to lift up confidence in First Republic, but yeah, that obviously hasn't happened. And today, the Wall Street Journal reported that JP Morgan, its CEO, working with others in the industry on a solution for the bank. That's all we know, a solution. And what happened, the bank is still down. So if you're asking what's next for the bank, a buyout, a failure, a bailout, no one really knows yet. Let's just find out what the headline is in tomorrow's market, and I'll probably give you a different, if not the same answer then.
All right, but we've seen Silicon Valley Bank, Signature Bank failing. Now First Republic is struggling. Are other U.S. banks going to be next? What are you seeing?
Well, some are and some aren't struggling. Obviously, if a U.S. bank is giving money to First Republic, giving it some cash to keep afloat, there's a good chance that bank giving the money is doing just fine. All I can really say is the following: the big banks, those that are one of the 11 that gave First Republic $30 billion in deposits, it's safe to say that they're doing all right. It's the others, those U.S. regional banks, those are the banks that are on the radar, but today they look to also be clawing back from last week's steep losses, like PacWest and KeyCorp. It seems like they don't have the same amount of red flags First Republic has, and that's why I can probably say for now it's limited to First Republic.
Well, either way, we will be watching with anticipation. James Sweeney in New York, thank you very much.
Thank you.
Octavio Morenzi is CEO of financial consultancy OPMAS. Thank you very much for joining us. Starting with First Republic, struggling with investor confidence, can First turn things around?
Well, it seems at this stage, basically, the equity markets have written off First Republic. I mean, if you look at the stock price today, it's down almost 50%. That's a staggering loss after a staggering week and month of losses already. So it's basically looking as if the markets have written this bank off and no, there's not going to be any recovery here, really.
OK, well, that's quite extraordinary. I'm sure there will be a lot of worry there in the US over that. And let's turn to another struggling bank, moving over to Europe now, Credit Suisse. In a shock move, the Swiss government arranging a hasty takeover by competitor UBS. But is this a good deal?
Well, I suppose it depends who you ask. Is it a good deal? I dare say the Credit Suisse shareholders think it's a very, very bad deal. And on the UBS side, it looks like a pretty good deal. They've got lots of guarantees in place. They're able to swoop up Credit Suisse for a pretty low price. So I would say for UBS shareholders, yes, it looks like a very good deal. But for the Credit Suisse shareholders, it looks like a very bad deal instead. A lot of the Credit Suisse shareholders, I think, are going to be scratching their heads saying, wouldn't we have been better off if this deal had not gone through? It's not possible that Credit Suisse was only worth about $3 billion at the end of the day. It must have been worth more than that, to somebody anyway. So I think they're going to be saying this was a very bad deal indeed for us.
OK, but, I mean, looking at UBS shareholders, yes, they've managed to get a cheap price here, but they are being punished in another way because, the bank has spent years of disciplined work trying to sustain and strengthen its financial health, and now shareholders are having this failed competitor foisted upon them.
Well, that's certainly a way of seeing it. I think UBS certainly has not had the time to go look through the entire Credit Suisse portfolio of transactions, of loans, of all sorts of dubious things that they might have done. So UBS is sort of buying this sight unseen. I mean, bear in mind, they only really had a weekend to go through this and agree to it. So UBS has been forced into this every bit as much as Credit Suisse has by the regulators and by the Swiss government. So I think ordinarily when you do this kind of merger between two banks, you're going to take a couple months to go through and do your due diligence and make sure you feel comfortable with their risk management systems, with their loan portfolio, with their investment banking transactions, with their trading positions, all those things you're going to go through with the fine comb. UBS has not been able to do that here. So they're basically buying this black box of stuff that they're not really sure what's in, that they've heard some bad stuff about, and they're about to find out what's really in there.
But was the systemic risk to the Swiss economy really significant enough for the government to bypass Credit Suisse shareholders and to make this deal go through no matter what? After all, Credit Suisse shareholders have been denied even the right to scrutinise the deal to see if it offers a fair price for their equity, the argument being, well, it could go bankrupt anyway. But for whatever parts of the bank survive, they would at least have the right to see whether the deal is going to be somewhat good for them.
I agree with you 100%. I mean, the Credit Suisse shareholders have been denied that opportunity. The UBS shareholders have also been denied the opportunity to vote on this kind of takeover, which would be the normal way to do things. I mean, the Federal Council in Switzerland has basically made use of emergency powers within the constitution to ram this through. Now, I think it's very questionable whether that's actually constitutional legal under Swiss law. I mean, basically, those emergency powers are supposed to deal with an incoming invasion of some foreign power or something of that sort. It's not the case that it's designed to deal with a bank being valued at the wrong valuation and the Federal Council thinking it might be better off if we gave that bank to somebody else. That's not the kind of emergency those emergency powers are designed to deal with. So I think this is not going to stand up to legal challenge by necessarily. I think the Credit Suisse shareholders are going to be running to the courts and saying this is not going to stand. We're going to challenge this and try and reverse this decision. This was unconstitutional and illegal action on the part of the Federal Council.
So this deal could still fall flat. Very interesting. Octavio Morenzi, thank you very much for that.
Well, let's bring in Hans-Peter Burghoff, who can talk us through this. He's a banking expert at Hohenheim University in Stuttgart and joins us from there. Now, stocks have risen again after the Credit Suisse takeover by UBS. So is the banking sector safe, or can we expect more problems?
For the moment, it seems to be safe. There is nothing like panic. But for sure, there's a higher vulnerability due to the increased interest rates. The central banks had to increase the interest rates very fast to fight inflation because they're just late. They could have done this more smoothly if they would have reacted faster, but they didn't. And this has big consequences on the values within a bank because banks have lots of long-term positions which lose value if the interest rates go up. And so the vulnerability is there. Banks that need liquidity right now, banks that are in trouble right now, get much more punished than in normal times.
Now, we all remember 2008, the financial crisis, which saw governments around the world intervene to save banks with taxpayer money. We were told this should never happen again, but apparently now it is happening again. States are making billions available to banks in crisis. Why is that?
Well, first, promising that it will never happen again is somehow against the construction of banks. Banks perform the function of a liquidity pool for the economy, which means they're always open to the risk of a run. And this is exactly what's happening right now. And you can have as much regulation as you like. You won't get this out of the system without just destroying the whole system. And unluckily, banks are very valuable for economies. So it wouldn't make much sense to have no banks at all anymore. So we must live with these imperfections. And I'm afraid the regulators were not too much aware of that. They believed if we've got a perfect system of control, nothing can happen. But that's not the real world. That's just the world of some technocrats. So what we need is a banking authority which really intervene fast and with with high competence in case of crisis. So far, this worked.
OK, so Credit Suisse is not just any bank. It's a huge player on the international financial market. Did banks like Credit Suisse not learn any lessons then from the 2008 crisis?
Well, Credit Suisse, in one respect, is a special bank. They did get through the crisis without state help. Unluckily, this put away too much of the pressure to change, to get into new standards with regard to safety, also get into new ways how to do banking with a closer look at risk all the time. So they just were too slow to change. And now they get into stormy weathers, and in stormy weathers, ships that are not well prepared will unluckily sink. So in this respect, Credit Suisse is a special case. But for sure, many other banks, which might be special case for other reasons, might be tested as well. And that's a dangerous time we are traveling into.
So you're saying that the ordinary people like you and me still have to worry about their savings in their banks?
No, I don't say this. I mean, the banking system is widely diverse in Switzerland, in Germany, very many different types of banks. Some of them are very sound. And generally speaking, banks profit from higher interest rates because it allows them to earn a higher margin. So it's kind of time inconsistency. For the moment, we've got large value losses in the bond portfolios of banks due to higher interest rates. In the medium term, banks earn more money. And banks that have rightly hedged their interest rate risk, they already earn much more money right now. So some big banks, especially the German banks, which have been very stressed in the past, they have very good results at the moment, look much more stable than they did maybe 5 years ago.
Hans-Peter Burkhoff there from Hohenheim University. Thank you very much for your expertise.
Great pleasure.